Sunil Tirumalai, Research Analyst, Emerging Market and India Equity Strategist with UBS Securities. Sunil, good morning. Thank you for joining us. We've had a good comeback in Indian markets from the recent low. What is your view on market and market valuations after the recovery, what we've seen from the recent low?
Yes, good morning. Good morning to your viewers too. Yes, so we have seen a reasonable underperformance of India starting end of last year and a recovery, right now. But I think overall, from a relative perspective, when I say relative, I'm talking relative to other emerging markets, other parts of Asia, etc. I think when I look at a framework of what is the earnings growth expectations from India and what are the valuations, I think India is still not super attractive. There are other parts of the emerging markets universe where you are actually getting superior growth outlook for the next couple of years at far compelling valuations, right? I think I think we still have India as an underweight in our EM universe. That Nifty target we have is about 18,000, which is like not too far away from where we are today. I think there has been a recovery, yes, but I think the overall from a valuations versus growth standpoint, I would still not be super positive at this moment.
Valuations versus growth standpoint, it's the risk reward ratio is not favorable. Can you define that for us? And what gives you this kind of a conviction that earnings may not surprise on the upside?
Yeah. So to start with, so the reason why the earnings have kind of held up over the last 6 months to or even a year is because the banks have been reporting really strong margin expansions, right? And I think it's fairly likely that we are coming to an end on that margin expansion story, and hence the support that you got from the banks could start coming off, and you could actually start seeing the rest of so banks are actually hiding the cuts that are happening in many other parts of the index, and those could start flowing through once again. I think the larger part of the index which could still drive earnings cuts could be the commodities sectors, and of course, to the extent that banks margins, there could be some compression. So I'm not arguing for a very sharp downside to earnings, but it's just that the growth upside seems better in some of the other markets than in India, given the context of what we are used to in terms of growth from India.
Coming in, banks, which has been the pillar so far for the markets, might see a bit of a derating and earnings might start to come off as far as that is concerned. Sunil, hi, this is Anisha also joining in the conversation. We were talking about how India has become the most populous country now in the world, how the discretionary spend is likely to go up further. What's your take on consumption and what's the best way to play that?
Yes, I think we are heading into a good time, I guess, for the consumption sectors. Generally, in a disinflationary environment, commodity prices have come off already, and there are more that could happen for some specific commodities for some specific stocks. So generally, we are heading into a good season or good period for consumption sectors. We choose to prefer the staples over discretionary. Given where the valuations, how much to the extent valuations have corrected, and the sensitivity of the stocks to rates. In our work, we found that surprisingly in India, the staples stocks are more rate sensitive, especially when we talk about rates in the US, and which is where our house view is for rates to come off significantly, and hence the tailwind support on valuations could be bigger for the staples sectors, against the discretionary sectors. So I think it's a good time to look at consumption, but I think we would prefer those staples rather than discretionary.
Sunil, morning. Wanted to understand your outlook on the IT sector. Clearly, due to the macro headwinds, it's not been the greatest of starts to the year. What is your outlook in terms of the underlying slowdown within the IT space? Do you think that it is going to continue to flare up and you would thereby remain cautious on the space?
Yes. So, if you're heading into a setup of a recession in the US. And this is a sector which is heavily dependent on the US, on the banking sector. And you're talking about consensus expecting about 8% to 10% kind of top line growth, which pre-pandemic would happen in a decent year. It was an average year, and this is unlikely to be an average year, right? So I think these uncertainties and pressures on top lines, projects suddenly getting cancelled, customers pulling back, that could be there for some time. So we have it as neutral rated in our picking order, the IT sector, because the stocks have also corrected post result season. But yeah, I mean, it's not something that's I would be a bit cautious about turning very positive at this point.
What about factors like buybacks? Could that change the way how IT stocks should be approached now? Because these companies are generating cash and doing buybacks.
Yes, so that gives you good support on the downside, right? I would tend to think of buybacks plus dividends as total distributions, and look at distribution yield. They are interesting levels, and they provide downside support. But which basically means that if they correct too much, then you can actually start buying them for that mean reversion. But from a fundamental perspective, I think the picture isn't too low.
A lot of banks are saying that there is no problem with the credit cycle. The 14 could become 13 and 15 could become 14, but the credit growth for FY24 looks solid. And when I look at brokerage opinions, whether it's UBS or Morgan Stanley or others, they are of the view that banks have reached the peak of their earnings. Do you think we are in for a surprise there?
So I think the peak of margins is what I think I would definitely agree with, and that's what even our banks team have been talking about. But on asset quality, it doesn't seem like we should be worried, at least from a 12 to 18 month perspective. And if you look back historically, asset quality cycles have been the bigger drivers of banks' performance than just margins, right? And you would be worried on the stocks if they were trading super expensive at a big premium, and hence even the correction on margins is a big risk, and you have to get away from the sector. I don't think we are at such a situation right now. So we actually have banks as one of the most preferred places for us in the market. Primarily because the credit growth, given the kind of nominal GDP growth that we have in India and the penetration levels, I mean, you'll get decent credit growth. We should be more focused on asset quality cycle, and that's where we should be kind of comfortable from the next 12 to 18 months perspective. And I wouldn't use the margins peaking and coming off as a big sell argument on the bank sector. I think the valuations are quite compelling given the context of where the valuations are in the rest of the sectors.
Okay, fair enough. Get in a sense as well as to what your outlook is for earnings as a whole. What makes you pessimistic and of the view that we're likely to see big earnings cut in FY24? Because just this morning, we were alluding to the fact that, yes, Infosys may have been a big washout in terms of one of the big tech nifty numbers that came out. But by and large, you can't use the same brush to stroke the entire gamut of nifty companies. It's not across the board. So what makes you confident that we are likely to see those earnings cuts?
So, yes, I mean, I think let me rephrase myself. I'm not talking about, very big earnings cuts, going forward. I would say where consensus is today for FY24, by the time we end FY24, we should probably have seen about 5 or 6% earnings cuts, which is par for the course. That's how normal sell side behavior is. What I'm talking about is that the level of earnings growth that we are talking about in India looks reasonably ordinary compared to the kind of earnings growth that we are getting in other parts of the world, and hence for example, over the last 3 to 6 months. Other than the technology sector in emerging markets, which is basically semiconductors, etc., which have seen sharp earnings cuts, most other parts have actually not seen cuts. They've actually seen increases, right? While India has continued to see some cuts, right? So that is the visibility and strength that is actually available in other markets. Whereas in India, that confidence on growth outlook and earning sustainability. I think that's a bit weak. So I'm not talking about risk of very sharp earnings cuts, but it's just that the earning growth outlook is not as attractive as it is in others.
It's been pretty interesting, and day after day, we're seeing some of these railway stocks, seeing a lot of traction in trade, a lot of progress, for instance, on the Vande Bharat trains, coaches starting production, etc. Wanted to just understand your view on this theme as a whole. How are you looking at the promising prospects that have been doled out by the government for sectors like defense and railways and infrastructure?
Yes, so I think government is one entity that's definitely doing a lot of capex. I mean, we haven't found much evidence of private sector and private corporates doing a lot of capex. And neither are there commentaries indicating that a big upsurge is seen. So yes, I mean, it makes a lot of sense to look at opportunities in the government capex space. I think our team likes. I mean, without getting into stock names, our team definitely likes the defense area. It likes the metro area, etc. And yeah, I mean, we do have positive bias on the industrial space as a whole. And there are some pockets of private corporate capital expenditure which can lead to some niche opportunities where our team is positive on. But I think at an aggregate level, it's the government space for capex which is really making sense right now.
All right, appreciate your time. Thanks very much, Sunil, for joining in and giving us your take on the markets as a whole, as well as your outlook on the earnings.